$1 million used to be the punchline to a joke. If I ever hit a million, I'm done. That was the story. You grind, you save, you invest, you cross 7 figures, and the world magically shifts from anxiety to comfort. In 2026, that story is dead. $1 million is not a golden ticket. It's barely a middle-class buffer. If you think I'll be fine once I hit a million, you are making the same mistake people made when they thought houses only go up, tech stocks only go up, crypto only goes up. You're confusing a big round number with actual security. The market doesn't care what feels impressive. It cares about cash flows, inflation, taxes, and how long you insist on staying alive. The psychology is easy to understand. For our parents, a million really was a kind of finish line. Lower life expectancy, cheaper housing, smaller medical bills, pensions that actually existed, interest on cash that actually meant something. $1 million at 65, pulling 5. 6% in bonds and CDs, plus a pension and Social Security could buy a comfortable, modest retirement. That world is gone. You are living in an environment where your lifespan, your expenses, and your risks have all increased, while safe returns have not obediently followed. In other words, the variables changed and most people refuse to update the equation. Let's do what they won't. Forget the word millionaire for a moment. Strip away the ego. Think like a bookkeeper. You are 60 or 65 or 70. You do not have 30 more working years to fix mistakes. You have maybe 10 or 15 workable years and 20 or more consuming years on the other side of them. That's the problem retirement math is trying to solve. Not how do I feel rich, but how do I avoid running out of money while I still have years left to burn it? Start with the basic dream. I'll get to $1 million, withdraw 4%, and live on $40,000 a year from my portfolio, plus Social Security. Easy. The so-called 4% rule is the comfort blanket of people who don't like arithmetic. It came from back tests in specific periods with specific assumptions, interest rate regimes, valuation levels, inflation levels that do not match the world you're living in now. Even its creator has said, in more cautious language, that 4% might be too high going forward if returns are lower or lifespans longer. But the myth persists. Why? Because nobody wants to hear that the number they've been chasing for 30 years doesn't buy what they thought it would. Let's be unpleasantly specific. Suppose you actually pull it off. You hit 65 with $1 million invested in a conventional balanced portfolio. It's a mix of stocks and bonds. Let's be conservative and assume you're not an idiot. No margin, no gambling, low fees, reasonable diversification. You're thinking, I can take 4% a year, adjust for inflation, and never run out. On day one, that's $40,000. Great. Now plug in everything else that's changed. First, inflation. The official numbers can say whatever they want. You live in the real world. Healthcare costs, rent, insurance, food. Everything that actually matters in old age has a bad habit of outpacing headline inflation. If prices rise 4% a year on average, that $40,000 needs to grow over time just to keep you standing still. In 10 years, at 3% inflation, your cost of living is about 34% higher. That means the $40,000 lifestyle you thought you were buying at 65 costs roughly $53,000 at 75. At 4% inflation, it's closer to $59,000. Your $1 million portfolio, if it also grows, can support that for a while, but the margin for error shrinks rapidly. Second, longevity. In 1970, making it to 80 was beating the odds. Now it's just normal. A healthy 65-year-old today has a very real shot at living to 90. That's a 25-year retirement, not a 10-year victory lap. That extra 15 years is where the $1 million is enough story dies. A 4% withdrawal that barely stressed a portfolio over 15 years can become a slow-motion amputation over 30. You don't feel it year by year. You just wake up one morning at 82 and realize the cushion you treated as bottomless now has a bottom. Third, sequence of returns. This is the killer nobody thinks about until it's already stabbed them. If the first 5 years of your retirement are strong markets, your portfolio can often tolerate even a too high withdrawal rate better than models predict. If those first 5 years are ugly, high inflation, low returns, or outright crashes, then even a seemingly safe withdrawal can become toxic. You are taking money out of a shrunken base, locking in losses that will never get the chance to recover. Two portfolios with the same average return over 30 years can have wildly different fates depending solely on whether the bad years came early or late. Run a simple mind experiment. Two 65-year-olds each retire with $1 million and withdraw $40,000 in the first year, adjusted for 3% inflation thereafter. Both earn an average return of 7% over 30 years. One gets the bad years at the end of life, the other gets them in the first decade. On paper, they live in the same market. In reality, the unlucky one runs a serious risk of depleting his portfolio in his late 80s. The lucky one, who suffered his bear markets at 85 instead of 66, dies with money. Same skill, same plan, different sequence. At 65, that difference is not an interesting theory. It's the difference between dying with a cushion and dying broke. Now add healthcare to this cheerful picture. In your 60s and 70s, your single largest unpredictable cost is not Netflix. It's your body. Premiums, deductibles, copays, drugs, procedures that aren't fully covered. In the United States, a decent estimate for total healthcare spending in retirement for a couple easily runs into the hundreds of thousands over 2 or 3 decades, even with Medicare. That doesn't mean you need that amount sitting in cash. It does mean that a meaningful slice of your portfolio's job is simply to absorb medical shocks. Your million is not a discretionary slush fund. It's an emergency fund on a 25-year delay. Do the arithmetic. A couple retiring at 65 with $1 million in 2 Social Security checks might gross, say, $40,000 from investments plus $40,000 from Social Security. $80,000 total. Sounds comfortable. After federal and maybe state taxes, their $80,000 might become $65,000, $70,000. Subtract housing, even modest rent or taxes, and maintenance can run $20,000, $30,000 a year in many places. Subtract healthcare premiums and out-of-pocket costs. Subtract food, utilities, transport. What's left is not the brochure retirement. And all of this assumes nothing goes seriously wrong, and that returns behave themselves. So when you hear $1 million is enough, you need to ask, enough for what, and under which assumptions? Enough if inflation averages 1. 2% markets hand you 8. 9% after fees, and you drop dead at 78 with no major medical events. Maybe. Enough if inflation is spiky, returns are lower, you or your spouse leave to 90, and you hit a bear market in your first years of withdrawals. Probably not. And remember, that's for someone who actually has the full $1 million in productive assets, not a house he refuses to sell, a car that depreciates, and $300,000 in a portfolio, plus a vague sense of being okay. In 2026, the risk picture is worse, not better. Valuations in many markets have spent years at elevated levels. Governments are drunk on debt. Central banks have spent a decade distorting interest rates. That doesn't mean you can predict precisely what returns will be. It does mean you're insane if you simply pay state. 10% real returns onto your spreadsheet and call it a plan. Munger's method here is simple. Assume the future will be at least as hard as the past, not kinder. Build in a margin of safety. If reality surprises you positively, terrific. If it doesn't, you're not on the street. What does a margin of safety look like in retirement planning? It looks like assuming a lower withdrawal rate than the sales pitch. 3% instead of 4%. Sometimes even 2.5% if markets are outrageously priced and your horizon is long. At 3%, a $1 million portfolio throws off $30,000 a year. At 2.5%, it's $25,000. Now combine that with Social Security. If you and your spouse can pull a combined $40,000 a year from the government and perhaps a small pension, you're staring at $65,000, $70,000 total in the optimistic version. Slice that with taxes and expenses and tell me if millionaire still sounds like an ironclad guarantee of comfort. Here's where inversion clarifies things. Don't ask, is $1 million enough? Ask, what conditions would make $1 million obviously not enough? High inflation, low real returns, long life, high fixed costs, bad early retirement markets. You already live in a world where several of those are not remote possibilities. They are facts. That should tell you the answer. $1 million by itself is not a safety net. It's a small blanket in a cold room. The concept of retirement that people still cling to. A clean break at 65 into 20 or 30 years of leisure funded by a magic number. Is dying for the same reason. Grew up in a time of pensions, generous interest rates, lower expectations, and shorter retirements. You are living in a different experiment, defined contribution plans, individual responsibility, rising healthcare costs, and lifespans that turn a 65-year-old into a person barely 2/3 of the way through life. Drag your parents' script into that world and you will find out the hard way that the script doesn't fit the stage. The death of retirement isn't a slogan. It's just recognition of the math. For most people alive right now, retirement is not an end to work. It is a shift in the kind of work you do, the hours you work, and the reasons you work. Your capital doesn't buy freedom from labor. It buys bargaining power. It buys the ability to say no to exploitation, to choose lower stress or part-time roles, to survive corporate stupidity and recessions without being wiped out. If you think $1 million in an account means you never have to produce economic value again, you are volunteering for a very rude awakening. So if $1 million is not enough, what is? 2 million? 3. The truth is not a new magic number. The truth is that the question itself is wrong. There is no fixed dollar figure that suits everyone, because what you need is a multiple of your actual realistic spending in a world where your money loses value every year and your body gets more expensive to operate as you age. You don't need a target number. You need a target ratio and a brutally honest view of what your lifestyle costs. Most people don't have either. They have a slogan and a hope. If you want to avoid being one of them, you need to stop asking, is $1 million enough? And start asking, what spending level can $1 million actually sustain safely given inflation, taxes, and my likely lifespan? And if the honest answer to that question is less than I'm spending now, the correct response is not to go look for a secret investment that rewrites the laws of arithmetic. It's to change your behavior. Increase capital, decrease required lifestyle, extend your working years, reduce the probability of catastrophic loss. That's not cheerful. It is correct. Most people will not ask these questions. They will keep citing the old finish line, convinced it still marks safety, and find out too late that the course moved. The only advantage you have is the willingness to look now instead of later and adjust. The death of retirement is real, but so is the possibility of designing a life where you don't end up old, broke, and surprised. The difference will not be decided by the market. It will be decided by whether you stop lying to yourself about what your capital can actually do in the world you live in now. If you want a blueprint for that design, you start with 3 brutal realizations. You'll probably live longer than you think, your costs will be higher than you think, and safe returns will be lower than you hope. From those assumptions, the idea that $1 million is enough collapses on its own. Then the real work begins, deciding what to do about it while you still have time to change anything at all. So start with the only number that matters. What do you actually spend? And how much of that spending absolutely has to be covered whether markets cooperate or not? If you insist on $80,000 a year of lifestyle and a $1 million portfolio, you don't have a retirement plan. You have a math problem. If you can live a decent, stripped-down life on $40,000 and you have 2 Social Security checks covering $30,000 of that, then suddenly the situation looks different. The portfolio is no longer being asked to carry the entire load. It's a supplement, not a single point of failure. In that world, a $1 million nest egg with a cautious 3% withdrawal rate, producing $30,000 a year, turns your total income into $60,000. That's survivable for many people. Notice what changed. Not the million, but the demand placed on it. Here's the part people hate. There is no way to make $1 million enough at any lifestyle level you choose. You can't ask a gallon of water to fill whatever size container your ego picked out. The real question is, what spending does this gallon support before I die of thirst? That requires inversion. Instead of starting with your desired lifestyle and asking how much capital it takes, take the capital you actually have, or can realistically reach, and ask, what lifestyle does this support safely? If that answer is lower than you like, you do not fix it by rewriting the laws of returns. You fix it by changing the lifestyle, adding more capital, working longer, or all 3. Run a concrete case. A 65-year-old has $1 million invested, low fees, no debt, and expects 3% real returns after inflation and friction. A reasonable assumption for a conservative mix. If he wants his capital to survive 30 years into his mid-90s, his safe withdrawal might be closer to 3% than 4%. That's $30,000 in year 1, adjusted upward with inflation each year. Add Social Security, say $24,000 a year, and his total income is around $54,000 before tax. Depending on where he lives and how he lives, that can be fine, or a slow-motion train wreck. If his housing and medical costs eat $35,000, $40,000, there's not much margin for anything else. Now look at another 65-year-old with the same million, but he's arranged his life differently. Smaller house, or fully paid off modest home in a cheaper region. Lower property taxes. No car payment. Health insurance planned carefully. His essential spending might be $35,000. Social Security covers $24,000 of that. The portfolio only needs to cough up $15,000 to meet basics, leaving another $15,000 of safe withdrawal for discretionary spending or future shocks. It's the same $1 million. The difference is that one man's life fits inside what the capital can reasonably support. The other man is trying to stuff a fantasy into a budget and calling the gap unfair. This is why chasing a raw dollar target is dumb. $1 million, $2 million, $5 mean nothing without a denominator. The denominator is your annual spend. Think in terms of multiples. If you can live on $40,000 and you have $1 million, your capital is 25 times your spending. Add a 3. 4% withdrawal rate, that's tight but defensible. If you need $80,000 a year, that same million is only 12.5 times spending. At a 4% rate, you'd be taking $40,000 from the portfolio just to fill the gap, leaving nothing to absorb inflation or bad years. You're yanking 4% in a world that may only safely support 3%, from a base that's undersized to begin with, while pretending that the future will be kind because you feel you've earned it. That's not a plan. That's entitlement dressed up as arithmetic. The illusion gets worse because people mislabel assets. They count the house they refuse to sell as part of their retirement. They count the car that will be worthless in 15 years the same way. They brag that they're millionaires because a website estimates their home equity generously and their 401k had a good quarter. None of that changes the cash flow reality. Your house does not pay you unless you downsize, rent a room, or reverse mortgage it. Your car burns money. Even your portfolio is not $1 million of spendable dollars. It is a machine that may safely spin off a small percentage each year without tearing itself apart. Confusing a balance sheet with an income statement is how people hit a magic number and then fall apart anyway. If you want a more grounded picture, forget the round numbers and do a simple 3-line calculation for yourself. Line 1, guaranteed income. Social Security, pensions, rental income you're certain will actually arrive. Line 2, minimally acceptable spending. The true cost of a lean, dignified life in your geography, including realistic healthcare costs. Not your current spend. The stripped-down version that doesn't involve impressing people you don't even like. Line 3, portfolio support. The amount your capital can safely contribute under conservative assumptions. Take an example. You're 58, aiming at retirement at 67. You and your spouse expect to combine $40,000 in Social Security at full retirement. You estimate your lean but decent spending at $60,000 in today's dollars, including housing, food, modest travel, and insurance. That leaves a $20,000 yearly gap in today's money. You want your portfolio to bridge that gap with a margin of safety. At a 3% real withdrawal, you'd need roughly $20,000, 0.03, equal sign $666,000 in today's dollars to cover the gap. That's not a dream. That's a requirement. If you have $200,000 today and you're stuffing $15,000 a year into it, you can see whether the math closes by 67 with plausible returns. If it doesn't, your choice is narrow. Raise savings, lower future spending, work longer, or accept more risk. But at least you're arguing with numbers, not with a slogan. The trap most fall into is refusing to adjust any of the variables they emotionally care about. They won't lower their target spending. It feels like defeat. They won't increase their contributions. It feels like deprivation. They won't extend their working years. It feels unfair. So they adjust the only variable that doesn't talk back, expected return. Instead of 4% real, they plug in 6%. Instead of 7% nominal for equities, they assume 10% or 12%. Magically, the plan now works. On paper. In the real world, they've just enlisted the market to hide their refusal to change their own behavior. Munger's framework hates that kind of self-deception. You start with reality, not with what you wish were true. Realistic return distributions, realistic lifespans, realistic expenses. You pick a withdrawal rate that would have survived ugly periods in history, not just the best ones. Then you ask a cruel but necessary question. Given this, how many years of retirement can I actually afford? And what does that retirement look like? Maybe the answer is, I can't afford 30 years of full-stop leisure, but I can afford 15 years of part-time, lower stress work layered on top of withdrawals, and another 10. 15 years drawing a bit more heavily once I truly can't work anymore. That sounds less romantic than quitting forever at 65. It beats finding out at 83 that your account hit zero. The reality in 2026 and beyond is that for most people, especially those who started late or earned average incomes, retirement will be a sliding scale, not an on/off switch. You might work full-time into your late 60s, then part-time through your 70s, then only occasionally afterwards. Your capital doesn't free you from ever working again. It gives you the leverage to choose how, where, and for whom you work. That leverage is real. A man with $1 million in low expenses can walk away from a bad boss far more easily than a man with $0 and a big mortgage. But that doesn't mean the million lets him sit on a beach for 30 years without thought. Here's another uncomfortable point. Your risk doesn't vanish when you stop earning. It shifts. Before retirement, your main risk is market volatility plus job loss. After, it's longevity plus inflation plus your own stupidity. Most people plan as if once they hit the number, they can start taking more risk because the hard part is over. That's backwards. Once you stop adding meaningful money and start withdrawing, you have less ability to recover from mistakes, not more. A 50% loss on $1 million at 45 while still working is a nightmare you can wake up from if you keep saving and the market eventually recovers. A 50% loss on $1 million at 68 while drawing $40,000 a year is something you may never truly come back from, because the withdrawals keep cutting into whatever rebound you get. So what do you do with all this? You stop treating $1 million as an endpoint and start treating it as a parameter in a larger, ongoing system. You ask, at my age, at my spending level, in this return environment, what behaviors make it almost certain that even $1 million will not be enough? Then you eliminate those behaviors. Lifestyle inflation in your 50S and 60S high fixed costs, early high withdrawals, overly aggressive allocations you can't stick with in a crash, pretending your house is a liquid ATM, using your portfolio as a toy. Each of those, on its own, might be survivable. Combined, they are the Lollapalooza of a failed retirement. Consider a man of 55 in 2026 with $600,000 saved, aiming for $1 million by 67. If he saves $20,000 a year and gets 7% nominal returns, he might get close. But if he also takes on a bigger mortgage, finances 2 new cars, and starts taking money out of the portfolio for once-in-a-lifetime vacations, the plan dies in real time while it lives on in his head. He might technically hit $1 million on his account statement at 67. But if he's trained himself to treat the portfolio as a piggy bank and his cost of living requires $90,000 a year, the $1 million is a prop, not a safety net. Contrast that with another 55-year-old who also has $600,000 but chooses a different path. He holds his housing costs flat or reduces them. He drives his current car longer. He increases his savings to $30,000 a year, not by some heroic new income, but by refusing to inflate his lifestyle. Maybe he works until 70, not 67, both increasing contributions and shortening the time the portfolio must support him. He reaches 70 with $1.30, $1.5 million instead of $1 million, a Social Security benefit that's 30% higher because he delayed claiming and a lower baseline of spending. The same man, the same marketplace, different relationship to ego and discomfort. One is a millionaire who can't stop working without imploding. The other is a millionaire who actually has options. This is the part of the conversation almost nobody wants to have. Your behavior in the decade or two before retirement matters more than the size of the number you circled on a vision board in your 30s. You can arrive at $1 million as a compulsive spender with fragile habits, or you can arrive at 2/3 of that as a disciplined saver with low expenses and realistic expectations. I'd bet on the second man to enjoy a more stable old age. The slogan "a million is enough" erases that difference. It suggests the outside number rescues you from inside habits. It doesn't. You also need to confront a basic point. The system you live in is structurally hostile to the old script. Employers are not lining up to fund your leisure for 30 years. Governments are not in love with the idea of you collecting benefits for decades without paying in. The investing world is not interested in helping you minimize fees and taxes. Every incentive in the environment pushes you toward overconsumption when young, overconfidence when markets are good, and panic when they are bad. You are swimming against the tide. Pretending otherwise is stupidity. Recognizing it gives you one advantage. Not mathematical, but psychological. You stop expecting the world to cooperate with your plan. You start building a plan that assumes indifference at best and hostility at worst. So yes, in 2026 and beyond, you should consider the traditional idea of retirement dead. Not because you can't ever stop working in any form, but because the one-number fantasy no longer matches reality for the vast majority. The question now is whether you want to keep worshiping that corpse, or whether you'd rather build something that actually has a chance of carrying your weight. Munger's approach is always the same. Face the brutal facts, then behave rationally anyway. That rational behavior in this context is not complicated, but it is offensive to the stories you've been sold your whole life. It means lowering your required lifestyle, extending your working years, demanding a bigger margin of safety from your capital, and abandoning the idea that a certain number in an account will magically take care of you while you stop contributing value to the world. Most people would rather cling to the fantasy. You don't have to be one of them. In practical terms, that means rewriting your personal rules about money, time, and work to fit the world you actually live in, not the one your parents inhabited. It means defining enough in terms of spending and safety, not status and slogans. And it means accepting that whatever number you have or reach, $500,000, $1 million, $2 million, you will still live or die by the same principles. How much you burn, how exposed you are to bad sequences of events, and how willing you are to keep doing productive things while your capital quietly compounds. If you want to walk away with something more useful than $1 million is not enough, you need a short set of rules you can remember and obey, even as the world screams the opposite at you. That's the only kind of retirement plan that still has a chance. Not a spreadsheet fantasy, but a handful of constraints that keep you from volunteering for poverty in your old age. Here are the rules. Not theories, not slogans. Constraints. Think of them as guardrails erected by someone who has watched a lot of people drive off the same cliff. Rule 1. Retirement is a cash flow problem, not a wealth badge. Stop asking, do I have $1 million? Start asking, how much reliable income can I generate? And what does my life actually cost? Do a 3-line calculation. Line 1, guaranteed income. Social Security, pensions, rental income that is genuinely dependable. Line 2, lean, honest annual spending. What it costs to keep you housed, fed, insured, and functioning, stripped of status ornaments. Line 3, what your portfolio can safely contribute at a 3.5% withdrawal rate. Do the subtraction. If line 3 plus line 1 is less than line 2, you are not financially retired, no matter what your account balance says. You may still choose to stop working. Just don't pretend you chose it. The math did. Rule 2, kill the idea of retiring at a specific age. Your grandparents could pick 65 as a finish line because their retirements were shorter, cheaper, and partially funded by defined benefit pensions. You live in a different world. Your retirement age is when your capital and guaranteed income can cover your lean spending with a margin of safety. For many people, that will be somewhere between 70 and never fully. That's not pessimism. That's arithmetic in a world where living to 90 is common. Design around phased work, full-time, then part-time, then occasional. Not around a fantasy of ceasing all labor at 62 and living happily ever after on one magic pile. Rule 3, assume lower safe returns and withdrawals than the marketing materials suggest. If long-term real returns after inflation and costs land in the 3-5% range on balanced portfolios, planning to pull 4% forever is already aggressive. Planning to pull 5% or more is volunteering for trouble. You don't protect yourself by plugging in 8% or 10% into a spreadsheet and feeling better. You protect yourself by planning around 3% withdrawals and being pleasantly surprised if reality turns out kinder. That's margin of safety. It's unexciting. It's also how you avoid eating dog food at 87 because your early retirement backtest turned out to be built on cherry-picked decades. Rule 4. Attack fixed costs like they're trying to kill you. Because they are. Every permanent monthly obligation you carry into old age is a claim on your future freedom. Housing, vehicles, insurance, subscriptions, debt payments. Here's the inversion. Instead of asking how much more capital do I need to support my lifestyle, ask how much less capital would I need if I cut this cost. A $1,000 reduction in monthly spending is $12,000 a year. At a 3% safe withdrawal, that spending cut is the equivalent of having an extra $400,000 in capital. You're not going to casually add $400,000 to your portfolio in your 60s. You can absolutely remove $1,000 of self-inflicted monthly nonsense if you're not enslaved to appearances. In old age, the cheapest dollar is the one you don't have to spend. Rule 5. No leverage, no complexity. No heroics with your retirement base. The money you are depending on to not die poor has no business being yoked to margin, options, exotic products, or anything you need a seminar to understand. Leverage, plus age, plus volatility, plus ignorance. That's a Lollapalooza of stupidity. It's rat poison for late life portfolios. The right move is painfully simple, low cost, diversified exposure to real businesses and cash flowing assets. If you want to gamble, do it with money you can watch burn without changing your lifestyle 1 inch. If there is no such money, you have no business gambling at all. Rule 6. Defend yourself against sequence of returns risk. You do not walk into day 1 of retirement 100% in equities unless you are either already very rich or very stupid. You need a buffer. Some combination of cash and short-term high-quality bonds. That can fund several years of spending without forcing you to sell stock into a crash. The exact number of years depends on your risk tolerance and other income. But think in terms of at least 2 to 5 years of basic expenses set aside. Inversion again. Ask if the market fell 40% in my first year of retirement, how would I avoid touching the wounded part of my portfolio? The answer is not hope it doesn't happen. The answer is you hold enough safe assets, and you're modest enough in your withdrawals that you can ride out storm years without cutting into bone. Rule 7. Build human capital into your plan, not just financial capital. The idea that your ability to earn becomes irrelevant the moment you hit retirement age is nonsense. The ability to generate even $10,000, $20,000 a year from part-time, lower-stress work in your 60s and early 70s is the functional equivalent of an extra few $100,000 in savings. At a 3% withdrawal rate, $15,000 a year of earned income is like having an additional $500,000 in capital. You might not ever see that extra $500,000 in an account. You can absolutely train, network, and position yourself to be the person who can still earn $15,000 a year doing something tolerable. Refusing to consider that because I'm supposed to be retired by then is ego, not strategy. Rule 8. Destroy lifestyle inflation in your 50s and 60s. These are your last real compounding years. Every time your income rises in this window, you are presented with a choice. Widen the gap between earnings and spending, or let it close again with upgrades. That choice dominates the difference between $1 million in fragile and $1.5 million and resilient at 70. A man earning $200,000 at 55, who lives on $100,000 and saves the other $100,000 for a decade, will reach a very different destination than a man who increases his spending to $180,000 and saves $20,000. Same pace, same markets, different appetite for looking rich to strangers. One builds a margin of safety, the other builds a facade. Rule 9. Treat your house as shelter first, capital second. For most people, their home is their largest asset on paper and their most immovable liability in practice. Counting precious home equity as retirement savings while having no intention of ever selling or downsizing is self-deception. If you are serious about survival in a world where $1 million is not enough, you at least consider the levers. Smaller home, cheaper area, shared living, house hacking in earlier years. You don't have to pull all of them. But you stop telling yourself that a large, illiquid, expensive house is the same as a portfolio you can draw from. It isn't. Bricks don't pay grocery bills unless you are willing to turn them back into money. Rule 10. Adopt pessimistic assumptions about the system and optimistic assumptions about your own behavior. That sounds backwards, but it's the only combination that gives you a fighting chance. Expect governments to underdeliver on benefits. Expect healthcare to cost more than you'd like. Expect markets to be choppy. Expect taxes not to fall in your favor. Build your plan around those expectations. At the same time, stop writing yourself off as incapable of change. You can work longer than the script said. You can live on less than the culture demands. You can learn enough about basic investing to avoid obvious scams. You can refuse to be part of the 99% who hand their fate to marketing slogans. All of this is just inversion at scale. Ask, what would a person have to believe in 2026 to think that $1 million guarantees retirement? They'd have to believe inflation will stay low and tame. They'd have to believe they won't live very long. They'd have to believe markets will deliver high, smooth returns on schedule. They'd have to believe they'll never have a major medical event, never support anyone else, never make a major mistake. In other words, they'd have to believe in a fairy tale. If you build your life around fairy tales, don't act shocked when reality vetoes them. You cannot control markets, governments, interest rates, or inflation. You can control your withdrawal rate, your spending, your work decisions, your asset allocation, and your tolerance for boredom over drama. Those levers are enough, if you pull them in the right direction, to make even a smaller number behave more safely than a million used recklessly. The death of retirement as your parents knew it is just the death of one particular story. It is not the death of your ability to age with some measure of dignity. The line between dignity and desperation in old age will not be drawn at $1 million. It will be drawn between those who updated their beliefs to match the world and those who insisted the world match their beliefs. If you're smart, you stop arguing with the math and start cooperating with it now. The big round number will not save you. Only discipline, humility, and the refusal to be stupid will.